Most people think primarily about income tax, not estate tax. That makes perfect sense, since very few people end up paying estate tax, or even having to worry about it at all. With a $23 million allowance per married couple going free of gift or estate tax, only those over that number face taxes. Yet Mr. Biden's tax plans reflect a massive change in how income and estate taxes interact, amounting to a big tax increase that will transform income taxes on death. First, the obvious points. Biden has proposed taxing long-term capital gains and qualified dividends at ordinary income tax rates of 39.6% on income above $1 million. But how about on death? This is where the change is much bigger. Recall that Hillary Clinton proposed a 65% death tax for the very rich, and Bernie Sanders has more recently said he wants to drop the $11.5 million exemption to $3.5 million. Biden has been less clear, but has also suggested that the current exemption is too high. Yet Mr. Biden's plan cuts deeper on many more regular people for much higher income taxes once you die. Here's how. After the Democratic National Convention, Mr. Biden pledged, no new taxes on incomes under $400,000 and on mom-and-pop businesses, but some of the $4 trillion tax plan he previously rolled out suggests otherwise. Currently, up to $23 million per married couple can pass to one's heirs free of federal gift and estate tax. However, income taxes are another matter, and that's where Mr. Biden proposes big changes. Biden's plan could leave you paying higher income taxes after a death by repealing present law's step-up in basis that increases the tax basis for inherited assets to their full fair market value upon death. Biden's tax plan calls for carrying over an asset's tax basis from the decedent to the next generation. No amount of estate tax exemption would help you, because this is a big income tax increase. Under present law, inherited property receives a full fair market value tax basis on death. The step-up in basis provides tax benefits for everyone passing down appreciated assets, including real estate, stock, family companies and more. For generations, assets held at death have received a stepped-up basis, to market value, when you die. Small businesses count on this. Say you have a family business worth $20 million that you started from scratch. How is it taxed if the married couple dies? Right now, the business goes free of estate tax to the kids. If both parents die, the $23 million estate tax exemption should mean no estate tax for that $20 million business. And the business gets a step up in basis for income taxes too. Say mom and dad die, and Junior gets the stock in the family company. No matter how small mom and dad's tax basis was in the stock gets stepped up to market value on death, $20 million. That way, Junior can run the business, or can sell it for $20 million and should pay no income tax.